Here are the U.S. futures. Have they changed at all after a status quo inflation report? Not really. They are up slightly more than expected, but likely not attributable to those inflation numbers, which have come in, very broadly speaking, in line with expectations. Well, let's digest these inflation numbers with Dylan Smith. He's senior economist at Rosenberg Research. Our featured guest, Brian Madden, will also help us as well. Dylan, thank you a lot for coming in this morning. Your take on the numbers that we've seen.
Well, I mean, as we've just heard, pretty much in line. I think, it doesn't do anything to shift the narrative that we have going into this week's Federal Reserve meeting. So I think markets reacting exactly as you'd expect. Not much to see here, and I think that gives the Fed ample room to essentially, wrap up the year on a quiet meeting, not do anything to disrupt market pricing, hold the line on, inflation is going in the right direction, but we want to see more. And essentially, stay pat on both, of course, where rates are, but also in terms of what they're projecting. So little action to come. Is
it a concern to the Fed that the monthly core pace of inflation rose by 0.3%? That was expected, but it is a pickup from October's monthly pace of 0.2% in core inflation.
Yes, and I think, in terms of what's pushing that, it's going to be coming from two sources, really, both in services. So we have rents still adding, a fair amount to the index. We think that will drop a little bit in the future. But the other component is what, Chairman Powell likes to call supercore. So that would be services X rent. And there we've seen a bit of a pickup going into the holiday season. Hotel prices are up, things like that. So not a huge surprise, but it's still going to be, I think, where the Fed pins their communication is, we've done most of the jobs. Goods prices are actually deflating, but we want to squeeze the last little bit out of services, and we'll stay where we are. Now, whether that's the right call or not, we'll start to see when we get, more growth and activity numbers for this quarter, which is already running quite weak. And so we're starting to enter this period where, the Fed is still hyper-focused on that last piece of inflation as demand starts dropping off. And that's going to set up a very interesting picture going into next year.
Dylan, do you think we're going to need to see evidence of softness in the labor market to get average hourly earnings growth down and then as it follows to get core inflation down? Do we need outright job losses or just fewer unfilled jobs as measured by the job openings and labor turnover survey?
Yeah, so I think that's really where the core of the debate is now. And of course, the reason that super core portion of the index is so interesting to the Fed is that that's where they believe that labor market results really push into inflation. So they'll definitely be looking for weakness in the labor market. We had quite a strong jobs report recently on the surface, but when you dug into it, a lot of one-offs going on, a lot of it happening in the public sector. Auto strike is coming back. And if you look at the more cyclical areas of the economy, that's where job losses were starting to come in. It's not quite translated into wages yet, but of course, wages are very backward looking. People are still re-indexing to inflation that's already happened. And so while, of course, that's a very important variable, over-focusing on that risks getting behind the curve, and that's where we're watching closely next year.
The Bank of Canada has said it sees 2.0% headline inflation in mid-2025. Has the Fed been as specific on its forecast?
Not yet, but we're going to have the survey of economic projections in this round, including the dot plots and forecasts. Haven't had a chance to break that down yet, but I think in terms of as markets digest the news and as we see what the picture is emerging there, that's going to set the tone, I think, for the next little while.
How difficult do you think it is to get to 2.0?
Not particularly difficult at all. And the reason really comes down to shelter costs and rent costs, where, by design, without getting too technical, the index doesn't want to include brand new rents. It wants to slowly re-index as rent contracts roll over. Now, we know from real-time measures that rental prices are somewhere between -1% and +1% in the U.S., way below the 7% or so that the CPI is capturing. That is a mechanical downward drift in the index that's going to come through, and it's going to push headline inflation, with nothing else changing, below 1%. And so it's not hard to get there at all.
If you mark that sort of artificial construct of backward-looking rents to market by looking at real-time asking rates for rentals, how much do you think that would take out of the CPI as computed?
We've done exactly that, and it takes the index basically to target. I think it's 2.2% last time we did it. So if you just throw in, if you replace the CPI rental measures with something like Zillow or Apartment List, that's where it gets you. So in that sense, the Fed if it wanted to, could make the argument that we're on target. But of course, that's not their focus.
Okay, with all of that discussion in the background, what kind of language, what kind of tone do you expect tomorrow from the Fed?
I think it's going to be, an effort to make as little change from the previous meeting as possible. Possibly, very similar to what we saw in the Bank of Canada language around, we think markets are coming into balance. We're happy with progress so far, but, somewhere to go, super core not where we want it. Nothing to see here, and we'll pick up next year is what we're expecting.